a lot of people that are allocate to hedge funds, they basically, I mean, one, you don't have to charge that much. So instead of a 1 in 20 hedge fund fee, you can charge like 0 and 10. And so you don't have to, charge a lot. But if you go to a big family office, it's not their thing to go short a stock. They'd much rather say, okay, how much do you want? And I had around 200 million of interest from different families, wealthy families, some names you would even recognize, some names Amy for sure would recognize. And they were like, yeah, that sounds like a really smart trade. And, how do you want to set it up? We'll give you some money. Obviously, you're not going to do it for free, but we're not going to pay like a hedge fund. And that's it, and there's many, Bill Ackman did this. Bill Ackman raised like, I want to say $4 billion for one single purpose fund. It was like, I forgot it was Target or Air Products or something. And so it is a little bit of a weird thing, a single purpose fund or a single purpose, trade. But like if a hedge fund is like, this trade is so good that I'm setting up a hedge fund just to do this one trade, it's kind of like, all right, let me hear the pitch. And, some people will do like, okay, I'll put 10 million in that, and then I'll do 100 million on the side without telling you. So people definitely do that out there, what you're saying. But I think there are people who are like, imagine some like Saudi sheikh or like some like super billionaire family like Michael Dell or something. It's like, bro, okay, I like what you're saying. I'll give you 100 million. If it works out, I'm happy, you're happy, and we'll keep doing business together. But if you f this up, your name's mud with me now. So I feel like that's kind of the dynamic, but you're absolutely right that like, you're talking about your perspective, which is like you trade maybe every day. So it's like, I don't need Martin for this. I'll do it myself. But put yourself in the perspective of some like 75-year-old matriarch who inherited $1 zillion from the Walmart, family. Like she's not sitting there, gonna babysit some trade, She's just like, here's the money, dude, charge me a small fee and that'll be that. So that's kind of how that works. Yeah, I mean, again, like I think people don't understand this sort of dynamic where you can short more as the price goes down. Speaking of which, the price of Beyond Meat seems to be going down. But you can add, as you go down. So like you don't have 100% upside. I mean, just a simple illustration is if I short 1 million shares of INQ at 80 and it goes to 60, I'm up, 20 million bucks. But if I short another 1 million shares, so I'm short 2 million shares at 60 and it goes to 40, I'm up 40 million now. And if I short yet 2 million more shares at 40 and it goes to 20, I'm up another 40 million. And if you add up the percentages, the IRR is very, very high. And the profits, as a percentage of the original capital are actually up a lot because even though in this situation, I'm not increasing my capital exponentially because the price is dropping. So you can sort of do the math on a spreadsheet and see that you can make more than 100% on a short, so long as you increase it as it goes down. But there's certainly a truism that the most the stock can drop is 100%, but that's not really the way I think most people look at it. I think from an IRR perspective, you calendarize or annualize the gain. So like if you make 10% long or short in one day, the IRR is off the charts. Even in a month, that's like a 200% gain almost annualized. It's not 120% because of the compounding. So that's the concept of IRR. So I don't think that's most like, I think when investors say that, it's almost always amateur investors. But there is this meta thinking about shorts that, people like Buffett and others have said, I don't short for a number of reasons. And Buffett's excuse was he feels like shorting is just a pain where the people behind the stock that is being pumped or whatever are going to try harder to keep it up than he has sort of the patience for. And shorting is not for everybody. I mean, I think it's like just not, well understood. And it's definitely not easy. And I think that the biggest mistake people make shorting, and I think this applies to professionals especially, is that they short good companies. And they short good companies with good management teams at bad prices, and they think the price is what matters the most. And I really think it's the quality of the company and the management team that matters the most. So like everyone who's short Tesla, I think is making a gigantic mistake because it kind of fundamentally is a good company, and it's kind of fundamentally a great management team. The price may be wrong. Like, the price is expensive, but like in 2 years, if Elon comes up with a lot of great new products and new stuff, like, you feel like an idiot, because the one thing you can't predict when you model, a lot of you guys see me modeling spreadsheets and stuff, but you might look at it and say, well, he doesn't know what Elon's going to come up with in 2 years. And I don't. So it's really hard to model Tesla, because what if he comes out with a new car that none of us thought about, or a robot or whatever, and all of a sudden it's a smash hit, and it's like, oh yeah, now it's a $5 trillion company. Oops. You know, you can do that kind of modeling with more boring companies. Like BYND has, like, just looking at the model, like, there's no chance for them to win. They need a miracle. And Tesla, they have a track record of miracles. So, like, to me, the shorts make huge mistakes when they short, like, realistically good companies or even okay companies. But shorting scams or shorting companies that have no possible way to succeed, those are my kind of things I like to short. And those traditionally have been pretty safe. Like, Quantum has been painful for sure. I lost millions of dollars shorting Quantum, but I made millions of dollars on my other trades. So for me, it's been still a positive year. And then now I'm finally starting to get paid on Quantum because it's coming down and people are realizing what I realized first. And I'd much rather realize it first than realize it late. And that leads me to being early sometimes in trades, and that's okay. You know, I can hang out and wait for times like now where they're starting to go in my direction. So that's kind of the way I look at shorting. It's definitely a weird art that you kind of have to learn from others, and you learn a little bit yourself. And from the outside looking in, it's very weird, but you know, it's really profitable because, as Amy knows, I mean, it's really not that hard to determine what companies are scams. Like, if you look at Beyond Meat and you're like, oh yeah, this is attractive, like, you're kind of an idiot, you know? But if you look at, or Quantum or anything like that, but if you look at like Ford or General Motors or Costco or Walmart or something like that, and you think that's a short, then I think you're also kind of an idiot. So I think, you know, sticking to like shorts that are just like really obvious, like trash companies that are never going anywhere, they don't have revenue, or they're lying about something, those are my favorite shorts. I do think shorts tend to go a little extra in that. Like, a lot of the shorts you talk to, and Amy knows this better than anyone, like, they're super cynical people. And I think that cynicism is often misplaced, where like they look at everything through this like negative lens. And I think if you do that, you will basically short great companies, because you don't know that they're great yet, and the market doesn't know that they're great yet. And Tesla looked awful years ago, and even the converts were trading at 80 cents, and Tesla was struggling, quite frankly. And Elon was like, I'll buy it out at 420, and everyone was like raising their eyebrow, like, what are you talking about, bro? How are you going to buy out the company? And then, you know, obviously years later, maybe a decade later, we saw how great the company was. And the shorts kind of just dug in their heels. They're still mad about it somehow. So when you short a good company, I think that's when I think when you short good companies, you end up paying the piper. And, you know, even if you're temporarily right, you know, it's a dangerous game. It's like picking up a nickel in front of a bulldozer. But when you short a real trash company that you know is a garbage can, you can kind of laugh at it as it goes up. Obviously, at some point, it stops being funny. You know, for Quantum, for a while there, I was sweating and, you know, nervous, but, you know, eventually rationality prevailed. And, you know, in 2000, when Druckenmiller was shorting the dot-coms, he capitulated, and he basically caused the top of it. But the funds I was at, between Cramer's fund and then the Tiger Cup I worked at, you know, we were kind of pretty cool customers, and just kept shorting it. But, you know, it doesn't mean that there wasn't occasional chair thrown, and occasional, like, you know, frustration. So it's a really tough game. But I think, you know, when you're in finance, you try to use any tool to your advantage. You might do distressed debt. You might do private equity. You might do shorting. You might do arbitrage. You might do computer trading. You know, there's hundreds of different like tricks and techniques you can master to make money. And sometimes there's markets where it's like, oh, like the SPACs. Like SPACs were like this money printer for a little while, because you basically had this free call option with the SPAC that you could get your money back if you didn't like the merger that was happening, or you got the shares if you saw that it was going to work out. So like Millennium, the biggest hedge fund practically in the world, basically did every single SPAC deal. And you're sitting there saying, like, weren't SPAC deals garbage? And it was like, no, if you sat down and listened to the story, actually SPACs were kind of this weird like dynamic where it was a win-win. And then, you know, there's other things like that where like these pipes in the quantum space, like QUBT is this like company that was a complete fraud basically, but the stock was at 24 and they were asking you to do a pipe at 18. And it's like, oh, that sounds pretty good. You know, I'll invest in that. And Citadel invested and Jane Street invested and all these guys invested and they sold the stock. They got it at 18 and they sold it at 22. And, you know, they made a fortune. So even in situations like that, you can kind of make some money. But I'm looking at some Korean stocks that, I mean, there's been a lot of movement in Korea on the AI kind of, you know, bubble, if you will. I don't think it's exactly a bubble, but whatever. And like Korea is often like wildly mispriced, usually awfully cheap. Not always though. And like, so I guess my point is like, you know, you should never, you know, limit your toolbook or toolkit. Like you should always be looking at like, you know, how can I expand my toolkit to new companies, new geographies, new sectors, new whatever. And like SK Hynix is a really, really good example where SK Hynix just makes the memory for NVIDIA's chip. And you might have missed the NVIDIA rally because, you know, I don't know, for you're living under a rock and you didn't hear about AI or you didn't use ChatGPT, but for everyone else, you know, starting in, I don't know, 2025, NVIDIA had already gone up a huge amount and SK Hynix hadn't really, but SK Hynix just basically doubled in the last like month or two. Because if you ask an AI engineer, what's the most important part of an NVIDIA chip, it's actually the memory. And with one Google search or one ChatGPT question, you could ask, well, who makes the memory? And you would think it's Micron, but it's actually SK Hynix and Samsung. And the more you read about, you could read on semianalysis.com, you do a tiny bit of research as to how these chips work. And it's like, no, that the RAM is like really the problem with these chips is like, you need more RAM. And, you know, just buying SK Hynix is like gone parabolic and it's not as microcap, it's this huge company. And there's probably a whole bunch of other companies in Korea right now that are like trading at 20 times earnings and that earnings is about to quadruple. But again, you know, it's never easy. I mean, there's, you know, you're looking for like just a slightly less hard trade, I think. And it's all hard. Like there's no free money. And I think a lot of people look at Beyond Meat or something and they're like, oh, it's gone up a lot. It's going to keep going, right? And like quantum, there was a guy on Twitter who bought IonQ at like 80. And he was like, I'm making a big bet. I know IonQ is going to keep going up. And like, that was literally the exact top. And, you know, I'm not laughing at him because I know how hard it is, you know, when you trade, because like, I thought 40 would be the top for IonQ. I was pretty surprised when it was 80 and pretty frustrated and stressed because, you know, thank God I made a huge amount of money in these other trades like Immune where I shorted, that stock went down 80%, or Spruce where I bought it and went up 8x. You know, I had a couple of nice trades to pad my balance sheet, but like, you know, quantum like went up, doubled on me like 4 times more than I thought it would. I was okay to eat one double, but then another double, another double, another double. It's like that, it's not too many more doubles before you're bankrupt. And does even if you're making money and other stuff. So it stopped, it's come down, but there's nothing to say that this is just a temporary drop and they'll be back up to 100 soon. So nobody knows. That's the beauty of the stock market. And the humility, you can be very arrogant that it's a bad company, right? And Beyond Meat, like I would tell you, it's a horrible company. I will not be humble about that. But you have to be humble about the stock, right? The stock can go anywhere. The stock is just 4 letters on your screen. It can go to $1,000 a share. It doesn't matter. It can go to 1 penny a share, conversely, right? So like there's no rhyme or reason necessarily. Now, generally you can assume the market will be somewhat efficient and somewhat rational, but you know, there is no legal restriction on this stock trading at $1 million a share. It can. Is it likely? No, of course not. Is it likely it even goes to 100? You saw what Amy said. Seems pretty unlikely, but is it impossible? Is it illegal? No, it could happen. And all it has to do is happen for 1 second to put you out of business. And remember, at that 1 second, somebody's also buying at 100 who's going to get on the way down. And sometimes these stocks are widow makers up and down. The shorts get killed, the longs get killed. The only person that made any money are the brokers and the high frequency guys, and maybe some of the market makers and things like that. And everyone else is a huge loser. The insiders made some money, of course, because they got stock for nothing, and they usually get very good timing on dumping their shares. So I don't know. I'm on a soapbox here, but I try to stick to the one thing I can control, which is, what does the balance sheet say? What does the income statement say? And, the common sense of this is, this company's never made money. It doesn't look like they ever will. And the Walmart agreement, a quick search would show that they've actually made this agreement many, many times, and they've said that they're expanding many, many times. And all that's happened is their revenue is contracted, not expanded. So yeah, I mean, they literally said in 2000 that they were going to expand to the same number. It's so weird. They said we're going to go from 800 to 2,400. And now they're saying they're going to go to 2,200. Did you expand or not? And it's like, did they go from 800 to 2,400 back to 800? And now they're going back to 2,400? It just, I mean, at the end of the day, the revenue tells you the story. The revenue is telling you they didn't. Well, I think that the two go hand in hand. If you consistently buying the stocks of bad companies, you're going to lose money. You may make money now, but it's not, likely that you will survive or prevail. Yeah, well, if you can make money consistently by buying the stocks of bad companies, I mean, that's a great trick, but it's
at the stock prices, whether they're smart or not, and nobody ever looks at the underlying fundamentals. The fundamentals never lie. Over the long term, the stock price will always follow the fundamentals. A company like Beyond Meat is absolute poo-poo, right? It's terrible. They don't have any customers. Anybody who doesn't like meat isn't eating processed chemicals, and anybody who likes meat isn't eating Beyond Meat. They've got no customers. And I think a point that Martin brought up before, which is very astute, is value isn't always defined as cigarette butts, Coca-Colas, buying things for 10 times free cash flow, right? If a company is compounding its revenue at 20, 30, 40%, like a company like Palantir, while also driving bottom line net margin expansion, right? It's hard for that to be expensive. So for you to come out and say, oh, it's trading at 300 times forward earnings, it's such a bubble. Well, you're wrong, right? Because the math catches up to it. But a company like Beyond Meat with negative gross margins and no real customers will always be zero. It's just a matter of time.
Yeah, I think so too. I mean, I think that's all correct. And the only thing I would add is, you have the option value. So if it was 10 cents, or whatever the stock price was at the bottom, you do have this option that maybe they'll turn things around. But at $4, you're basically hoping that somebody else will buy the stock after you buy it, which is, hoping could work. I mean, you maybe even have a 50-50 arguably. But I'd much rather get into investments where I have a 90-10, where it would require something crazy for me to lose. And so shorting quantum, or buying this, I bought a drug company stock recently called Sarepta. Sarepta is at 1 or 2 times sales. And in the history of pharmaceuticals, it's very, very rare to get these kinds of assets for 1 or 2 times sales. And, there was still a risk, but it was disproportionately likely that I would profit. Whereas Beyond Meat, you're just playing musical chairs. I mean, maybe the guy next to you will buy it for $5 and then you'll feel smart. But unless you could point to me where or why in the long run, this stock is worth $10, $20, $30, why do I want to take that gamble? Yeah, the market will always offer you chances to gamble. You can go to AC I'm near AC, but you can go to Vegas tonight, and there's 85,000 kinds of games to play. But guess what there is not? There is no roulette wheel with 90% odds. They don't have that machine at Vegas. They only have money-losing machines. And the same thing is in the stock market where, most of the stocks you're looking at, 8,000 US stocks, there's only a handful that are really going to work out. And people look at the average S&P returns. Well, what that doesn't tell you is that the median stock does not do very well. It's those big companies like NVIDIA and Palantir that power that big average return. Because those companies get bigger, their representation in the index gets bigger, the average stock actually goes down over time. So when people say, well, you know, stocks go up over time, well, which stocks? Yes, Microsoft, NVIDIA, Apple, after the fact, you can tell that, yes, they went up over time. But just throwing darts at the stuff like Beyond Meat, I mean, more likely than not, you're going to lose your money. And if you can't look at the balance sheet or income statement and say why you're right and the market's wrong, there's nothing wrong with being a contrarian and saying, no, no, the market's got it all wrong. What does the market have all wrong about Beyond Meat? You know, the market's saying it's going to drop. The revenue has been dropping. It's going to keep dropping. What are they going to do that's going to turn around? Now, if you sit down with the CEO and the CEO says, no, no, you don't understand. We're coming out with the Beyond, I don't know, they're going to do a drink. And the drink is going to be huge. Yeah, something crazy that's out of left field. Totally going to turn things around. You don't get it. We're going to be a SaaS play. We're going to sell software and meat. You know, something really wild that works out.
AI.
Yeah, it's AI meat. Totally AI meat. And, you know, that could work and then, you know, have a reason to believe. But at the current moment, you know, it takes a lot to turn around a company. Like, you can't take a dog and turn it around. It's very hard. So what's turning around here, it doesn't look like anything. And the product, you know, as Steve said, I mean, the product was tried for years and years and years and never took off. You know, the meat market is gigantic, and they got 400 in revenue. It cost them 500 to make just the meat. I mean, there's really hasn't been too many bigger disasters in capitalism than Beyond Meat. I mean, maybe WeWork. So this last gasp of like survival is, you know, again, it's almost like a gift to the bondholders and short sellers, and it shows the old saying that, you know, hope springs eternal and a sucker's born every minute. Because it's just, you know, the same old kind of like people running to the guillotine. And, you know, I always try to stop this because a small part of me feels guilty for sort of shorting it and saying, why are these people just so desperate to throw their money away? I mean, you're donating your money to .72 and to the other bondholders who are literally just printing money right now thanks to your generosity. The same thing happened with AMC, where the AMC.
So I think most people in this one kind of know that those names are kind of trash. I think more tactically though, the real question is expression, right? So when you start to have these things come your way, are you sort of recasting that short on a daily basis? Do you have like a framework for how you think about that cadence? And then do you ever consider, like, when things are really egregious, like the quantum basket now, to take like a more leveraged short position or use one of the daily directional instruments? How do you think about that stuff?
Yeah, I mean, I don't need to use the crazy triple levered ETFs or anything. I mean, what I would do and what I did do is like try to change up my balance sheet a little bit. You know, when you're a short seller, you always need extra capital on the side just in case. I mean, every investor kind of needs extra capital on the side just in case things.
Yeah, sizing is super important.
Yeah, like so if things go out of hand, like where is your extra capital? Is it in real estate? Is it in bonds? Is it in some hedge fund that you can pull your money out of? Like, you should always have some diversification where if your primary equity book is like the unprecedented has just happened, like quantum was pretty unprecedented. The last precedent was literally 25 years ago in the dot-com bubble. I need to go find that capital because, you know, this is, I can either chicken out of the trade, which is totally fine. Nobody should be afraid of chickening out. But I was like, no, this is going to work. I'm going to stick to it. I have to go, you know, find the capital to sustain the trade. At some point, you know, it's going to be so painful that, you know, I'm going to eat a huge loss. But I wanted to stick in the trade, and it worked out thanks to this recent decline. But I think it's always healthy to have, like, you know, this is what the genius of Warren Buffett is. He has this operating business. And if you have an operating business, you literally have capital coming in every year from the business that you're running. And the business is spitting off cash flow. 2025, you lose $1 billion, you know, in trading, but your business is making $1 billion every year. And, you know, if the number is more familiar or comfortable with you, just say $1 million. You have a laundromat, right? Laundromat makes $1 million, little chain of laundromats. Anybody can build one, just hard work. Half the Koreans in America have one. And, you know, you make $1 million from the laundromat and you go put it on 0-day call options and lose it all. Well, guess what? Next year, you still have laundromat earnings. It's a beautiful thing. If you save up $1 million over the years trading and you go all in on something and you lose it, well, you're literally back to zero. So if you have a business that's throwing off cash flow, you can afford some mistakes. And that's a really beautiful thing to have. Buffett has like 3 or 4 of those. He has operating businesses, he has float, he's got his investments. All of those things allow him to keep compounding, but he doesn't even take those speculative bets, but he doesn't need to. But in 2008, when it came time to, when basically you had your picking of any investment opportunity you wanted, your dream investments, he was able to get warrants on Goldman Sachs and Bank of America, 2 of the most important companies in the world. And he was not only able to invest at them at good prices, but he was even able to get a kicker of warrants, which is totally unprecedented. So having that extra cash or that extra value somewhere that you can monetize or convert into cash, it's like the most powerful thing in the world. And